Picture this. It's 1929. You wake up one morning, grab the newspaper, and read a headline that stops your heart cold. Stock market collapses. Trillions of dollars wiped out overnight. People who were millionaires yesterday have nothing today. Some of them couldn't take the pressure, and right in the middle of that chaos, there was one man who lost nearly 70% of everything he had. His name was Benjamin Graham, but instead of giving up, he studied hard for years. And 20 years later, he wrote a book that Warren Buffett would go on to call the best book on investing ever written. That book is called The Intelligent Investor. Today, we're going to break it down. Not the boring version, but the version you can actually use. So stick around, because this might be one of the most valuable videos you'll ever watch on investing. Let's get into it. Part 1. Investor vs. Speculator. All right, Graham's very first question hits hard. Are you an investor? Or a speculator? Obviously an investor. That's why I buy stocks. Hold on, because according to Graham, most people who call themselves investors are actually speculators, and they don't even know it. So what's the difference? An investor is someone who does thorough research before buying anything. They want to understand how healthy the business is, whether the price makes sense, and they're in it for the long haul. The goal isn't to make a quick profit tomorrow. It's steady, reliable returns over years and decades. A speculator? The complete opposite. They buy because they heard a rumor, or because the chart's been going up, or because a friend told them it's a hot pick. They don't really care about the underlying business. They just want the price to go up. Sound familiar? Graham says speculation is essentially gambling dressed up in a suit. You might win a few times, maybe even win a lot. But long term, if you don't understand the value of what you're buying, you're just waiting for your turn to lose. And here's the thing. Speculation isn't inherently evil. It's fine as long as you're honest with yourself that it is speculation, and you're not risking money you can't afford to lose. But if your goal is to genuinely build long-term wealth, you need to learn to be an investor. And that's exactly what we're going to talk about for the rest of this video. To erase. Part 2. MR. Market. Your unstable business partner. Now we get to one of the most iconic concepts in the entire book. Graham calls it Mr. Market. Imagine you own a small business with a partner. That partner's name is Mr. Market. And he's a little emotionally unstable. Every single day, without fail, he shows up at your door and offers you a price, either to buy your share of the business or to sell his share to you. Monday morning, he shows up grinning ear to ear. Hey, business is incredible. The future looks amazing. I'll buy your share for $1,500. Wednesday afternoon, he shows up looking miserable. Oh man, I think we're going under. I'll sell you my share for just $700. Friday night, he's back again with a completely different number. Depends on his mood that day. Now here's the question. Would you let Mr. Market's mood swings determine how much your business is worth? Of course not. If the business is running well, the products are selling, and management is competent, the value doesn't change just because Mr. Market is having an emotional day. But here's the thing. This is exactly what happens in the stock market every single day. When prices go up, people rush to buy. When prices fall, people panic and sell. They follow Mr. Market's mood, buying high, selling low. The exact opposite of what they should be doing. Graham's message is clear. Don't let Mr. Market be your boss. Make him your servant. When he's being overly pessimistic and offering rock-bottom prices, that's your opportunity to buy. When he's euphoric and offering prices that make no sense, that's your opportunity to sell. And most of the time, close the door. Ignore him entirely. Warren Buffett, Graham's most famous student, once said, if he could remove one button from every investor's computer, he'd remove the one that shows real-time stock prices. Why? Because watching prices every second triggers your emotions, and emotions are the biggest enemy of any investor. Part 3. Jargon opacity, the most important concept. Alright, now we get to the absolute core of Graham's philosophy. The most important concept. The one he says is the foundation of every sound investment decision. It's called margin of safety. Let's use an analogy to make this concrete. Imagine you're an engineer designing a bridge. You've done the calculations, and under normal conditions, the bridge will handle about 10 tons of load. Cars, small trucks, motorcycles. So what weight do you actually design the bridge for? If you say 10 tons, you're a bad engineer, because real life isn't always normal conditions. There are storms, heavier than usual vehicles, materials that wear down over time. A good engineer designs the bridge to handle 30 tons, 3 times the expected load. That's margin of safety. The exact same logic applies to investing. Let's say you've done your research and you've concluded that a stock's intrinsic value is $100 per share. That's your best estimate. How much should you pay? If you pay exactly $100, you have zero margin of safety. If your estimate is even slightly off, you've already overpaid. Graham recommends buying at a minimum discount of 30 to 50% from intrinsic value. If the business is worth $100, wait until the price drops to $50 to $70. That sounds extreme, but there are solid reasons for it. First, your estimate could be wrong. Financial analysis isn't an exact science. Second, business conditions can deteriorate unexpectedly. Third, markets can stay irrational far longer than you'd ever expect. Margin of safety acts like a cushion. If everything goes according to plan, you make strong returns. If something goes wrong, you're still protected. And Graham doesn't just apply this concept in one dimension. There are actually 3. First, price versus value, the most obvious one. Buy below intrinsic value. Second, diversification. Don't put all your eggs in one basket. Graham recommends holding 10 to 30 different stocks. If one turns out to be a mistake, the others protect you. Third, fundamental quality. Choose companies with low debt, a consistent earnings track record, and a history of paying dividends. Because when a recession hits, these are the companies that survive. All 3 dimensions together. Build a fortress around your capital. Habit 4. 2 types of investors. All right, now Graham asks us to be honest with ourselves. Which type of investor are you? There are 2 types. First, the defensive investor. Second, the enterprising investor. Let's break them both down. The defensive investor is for someone who doesn't have a lot of time to spend researching stocks, doesn't want to stress about the market every day, and whose primary goal is not to lose money, rather than trying to beat the market. The basic strategy is surprisingly simple. Allocate 50% to stocks, 50% to high-quality bonds. You can adjust that ratio between 25 and 75% depending on market conditions, but never go all in on one asset class. This is margin of safety applied to asset allocation. For stock selection, Graham has strict criteria. Large, established companies with healthy finances, no losses in the past 10 years, consistent dividend payments, and a valuation that isn't stretched. One more thing worth noting. Graham lived before index funds existed, but he almost certainly would have loved them. Instant diversification, low costs, returns that match the market. Perfect for the defensive investor. The expected return is realistic, 6 to 8% per year. That might sound modest, but if you stay consistent for 20 to 30 years, compound interest will absolutely blow your mind. The enterprising investor is a different story. This is for someone who genuinely wants to put in the work. We're talking 10 or more hours per week on research. You actually understand financial statements, and you can stay rational when the market is in full panic mode. The strategy here is more active. Hunt for undervalued stocks. Look for special situations like mergers or corporate spin-offs, and dig deep into management quality. But even for the enterprising investor, Graham gives some serious warnings. Don't try to predict when the market will go up or down. That's called market timing, and almost everyone who attempts it fails. Don't short-term trade. Buying today and selling tomorrow isn't investing, it's gambling. Don't chase IPO hype. Newly public companies are usually overvalued because of market euphoria, not actual business value. If you're disciplined and skilled, an enterprising investor can achieve returns of 10 to 15% or more. But it requires serious dedication. Think of it as a part-time job or even a full-time one. Here are the honest questions you need to ask yourself. Do you genuinely have the time and energy to be an enterprising investor? Do you actually understand financial statements? Or do you just feel like you do? Can you stay calm when your portfolio drops 30% in a single week? If the answer is no to any of those, be a defensive investor. There is absolutely nothing wrong with that. A disciplined defensive investor will build significant wealth over time without the soul-crushing stress. Part 5. Fatal mistakes to avoid. Okay, this is probably the part most directly relevant to a lot of people right now. Graham identifies several classic mistakes that investors repeat generation after generation. Mistake number 1. Buying growth stocks at any price. In the 1960s, there was something called the Nifty 50 Bond. 50 top growth stocks that people said couldn't go wrong. IBM, Xerox, Polaroid, world-class companies. The problem? Investors were paying insane prices. P/E ratios of 50 dis, 80x, even 100 bis, meaning they were paying prices that had already baked in extraordinary growth for years into the future. And what happened? When growth started to slow, and growth always slows eventually, these stocks collapsed 70 to 90%. The lesson? There is no company good enough to buy at any price. Price always matters. Always. Mistake number 2. Following the crowd. 1999 to 2000. Everyone was buying dot-com stocks. The internet will change everything. Valuations don't matter. The old economy is dead. You know how that ended. The bubble burst. Trillions of dollars evaporated. Countless companies went bankrupt within months. Graham says the moment everyone knows something is a great investment, that's usually the worst possible time to get in. Because if everyone already knows and everyone is already bought, the price is already too high. Contrarian thinking doesn't mean always going against the crowd. It means thinking for yourself, rather than following the herd. Mistake number 3. Picking the wrong advisor. Many financial advisors are paid on commission for every trade you make. The more you trade, the more they earn. Their financial interests may not actually be aligned with yours. Graham recommends finding a fee-only advisor, someone who gets paid a flat fee, not a transaction commission. Or better yet, educate yourself and manage it on your own. If you're using mutual funds, choose ones with low expense ratios. Mistake number 4. Over-relying on forecasts. Economists, analysts, market gurus, they all make predictions. And almost all of those predictions turn out to be wrong. Graham once said something that stuck with me. The investor's chief problem, and even his worst enemy, is likely to be himself. Not the market, not the economy, not government policy, but our own emotions. Greed when markets are rising, fear when they're falling. Top 6. A simple formula for success. All right, we've covered a lot of concepts. Now, how do you actually put this into practice? Graham's framework is genuinely straightforward. For a defensive investor, the portfolio looks like this: 50% bonds, 50% stocks. The stocks can be index funds or 15 to 20 blue-chip companies that meet Graham's criteria. Once a year, rebalance. If stocks have grown to 60% of your portfolio, sell some and move it back into bonds. If stocks drop to 40%, sell some bonds and buy stocks. Simple, unglamorous, and it works. Before you buy any stock, ask yourself these 6 questions. 1. Do you genuinely understand this business? If not, don't buy. Stay within your circle of competence. 2. Does this company earn money consistently? Look at the last 10 years of earnings. If it's erratic or frequently unprofitable, skip it. 3. Is the debt manageable? A debt-to-equity ratio below 50% is solid. Above 100% is a red flag. 4. Is management trustworthy? Read the annual reports. Are they transparent about challenges? Do they acknowledge mistakes or do they always find excuses? 5. Is there a margin of safety? Is the current price significantly below intrinsic value? If not, wait. 6. Are you prepared to hold this for 5 to 10 years? If the answer is no, don't buy. This is investing, not trading. Part 7. Inflation, the silent enemy. There's one more thing Graham emphasizes that people constantly overlook: inflation. Imagine you stashed $10,000 under your mattress. 5 years later, the cash is still $10,000. But its purchasing power? Maybe equivalent to just $7,000 or $8,000 now. That's inflation, a thief that quietly steals your wealth without making a sound and without sending you a notification. If inflation averages 3% per year, your money loses half its purchasing power in 24 years. If you're planning on retiring, and living another 30 years after that? This is not a small problem. Graham's solutions? First, stocks as an inflation hedge. Companies can raise their prices in line with inflation. Over the long run, stocks protect your purchasing power, far better than cash or fixed deposits. Second, real estate. But carefully. Property is also an inflation hedge, but don't over-leverage and don't speculate. Treat it like an investment, not a get-rich-quick scheme. Third, don't try to time inflation. Stick to your disciplined allocation. Don't make drastic portfolio changes just because you predict inflation will rise or fall. Silasing, becoming an intelligent investor. All right, we're almost at the end. And this is the part I think matters most out of everything we've covered. Graham says, being an intelligent investor has nothing to do with a high IQ, nothing to do with access to exclusive information, nothing to do with being a math genius or being able to read charts. It comes down to 4 things. Discipline. Stick to your principles, even when everyone around you is panicking or euphoric. Patience. Wait for the right opportunity. Don't rush. Rational thinking. Separate emotion from decision-making. Continuous learning. Always learn from mistakes, your own and everyone else's. And if you want to distill every lesson in this entire book down to 3 core principles, here's what Graham wants you to remember. First, margin of safety. Always buy at a significant discount to intrinsic value. This protects you from estimation errors, bad luck, and the unexpected. Second, Market is your servant, not your master. Use market fluctuations to your advantage. Never let the market's mood dictate your decisions. Third, buying stock means buying a business. You're not buying a piece of paper. You're not buying a lottery ticket. You're buying a share of a real business with employees, products, and customers. Treat it accordingly. Building wealth is a marathon, not a sprint. There are no shortcuts. There is no secret formula that makes you rich in 3 months. What exists are simple principles applied consistently over decades. Live below your means. Invest the difference regularly. Diversify to reduce risk. Buy with a margin of safety. Hold for the long term. Rebalance periodically. Don't panic sell. Don't euphoria buy. And let compound interest do the rest. Warren Buffett once wrote in his letter to Berkshire Hathaway shareholders, if you follow the principles in chapters 8 and 20 of The Intelligent Investor on Mr. Market and Margin of Safety, you won't go wrong. 1 student, 1 book, 1 decision to truly learn, and it changed everything. The stock market will keep being volatile. There will be bull markets that make you feel like a genius. There will be bear markets that make you want to quit. But if you hold to Graham's principles, buy with margin of safety, diversify, think long-term, control your emotions, you will be just fine. As Graham wrote in the closing pages of his book, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. So stay humble, stay disciplined, and let time work for you. Welcome to the world of intelligent investing. If you got value from this video, hit like and subscribe. And if you have questions about investing or other finance books you'd like us to cover, drop them in the comments below. See you in the next one.